In this video, we are going to look at cost of debt. We understand that there are two main forms of debt finance, loans and bonds. We are going to first look at this concept of cost of debt in the context of loans and apply the principles that we have learned in the context of bonds to look at the same concept of cost of debt. Let's take a simple example to understand the concept of cost of debt in the context of a loan. Let's say we have a company which has raised loan from a bank. So we have a bank, we have a company, and the company has raised finance from the bank in the form of a loan. And we do understand that this is a form of debt finance. Let's assume that the bank has extended a loan of rupees 1000 to the company, and this is for a period of 1 year. So let's say that this is a 1 year loan, and at the end of 1 year, the company returns the money to the bank at 1120. Now, the first thing we'll have to understand here is it's in this capital movement process, we understand that the bank is the investor and the company is the investee. Now, why do we say this? From the perspective of the bank, by giving a loan, it has invested 1000 rupees in an asset. For the bank, the loan that it has given is an asset. So from the perspective of the bank, it has invested its money in an asset. So we call the bank as an investor. And the entity to which the bank has given the money has accepted the investment of the bank, has taken the investment of the bank, and that's why we call the company as an investee. And the investee is the entity which is raising finance. So we understand that the bank is the investor and the company is the investee in this capital movement process, and capital is moved in the form of debt. Now let's understand what is in it for the investor, which is the bank, and what is in it for the company, which is the investee. We understand that for the investor, which is the bank, there is going to be a return on debt investment, and for the investee, which is the company, there is going to be a cost of debt finance raised. And we do understand that at a concept level, the return on debt investment is going to be equivalent to the cost of debt finance raised. So we are going to be looking at this example first from the perspective of the investor and understand the return on debt investment. And then we are going to be looking at the same example from the perspective of the company, which is the investee, and understand the cost of debt finance raised. So let's first take a look at this example from the perspective of the bank, which is the investor. And for this understanding, let's draw a simple timeline. We have T0, which is now, and let's have T1, which is going to be the end of the first year. So we have T0 and we have T1. Now we understand that at T0, the bank has given the company a loan of 1000 rupees. And we also understood that the loan that was given by the bank to the company is an asset. So at T0, as soon as the bank extends the loan to the company, the bank has an asset of 1000 rupees. Now, what happens at T1? The company repays the loan to the bank. The company pays the bank 1120. Let's put that in the timeline here at T1, 1120. Now, as soon as the bank has received 1120, we can say that the bank has 1120 of cash with it, 1120 of money with it, and this is also an asset. So at T0, the bank has an asset, and at T1 also the bank has an asset. At T0, the asset value is 1000, and at T1, the asset value is 1120. What we understand is, though the bank has an asset at T0 and also an asset at T1, we can see that the value of the asset is different at T0 and at T1. No, and we also understand that at T1, the value of the asset is higher than what it is at T0. So from this, what we can understand is the asset has grown in value in the 1 year time. From T0 to T1, in the 1 year time, the asset has grown from 1000 rupees to 1120 rupees. And this growth in the value of asset is what we call as the return on investment for the bank. Now, let's say this didn't happen. Let's say the company repaid the bank only 1,000 and it did not repay 1,120. Let's say the company repaid the bank only 1,000. In that case, we are going to be having an asset value of 1,000 at T0 and we're also going to be having an asset value of 1,000 at T1, which would mean that there is no growth in the asset value. And if there is no growth in the asset value, there's actually nothing for the investor which has invested its money. But in this case, there is definitely something for the investor which has invested its money, and that something is only the growth that has happened in the asset value, and the growth that has happened is what we call as the return on investment. And further, since this is a debt investment, we call this as return on debt. Now, let's understand what this growth is. What is this growth in asset value? We have 1,000 here, and over a period of 1 year, the 1,000 has become 1,120. So I can say 1,000 grows at some rate. Let me probably call this, let me assign this a variable R. 1,000 grows at R percentage to 1,120 over a period of 1 year. So I can say 1,000 into 1 plus R is equivalent to 1,120. And if I solve for R here, I get R is equivalent to 12 percentage. So what do I understand from this exercise? I understand that the bank, which is the investor in our example, has earned a return of 12% on its investment. And this 12% is what we call as the return on debt investment. And this is also because the asset for the bank has grown in value by 12%. Now, since we understand that the return on debt investment is what is also the cost of debt finance for the entity which raises debt finance, we can definitely say that the company here, which is the investee which has raised finance, is going to be having a cost of debt finance of 12%. However, let's understand this example from the perspective of the company also. So let's draw another timeline, and now we are looking at the same example from the perspective of the company. So we have T0, which is right now, and we have T1 in the timeline, which represents 1 year from now. And at T0, the company has raised 1,000 rupees from the bank. And for the bank, the 1,000 rupees which it gave to the company was an asset. But for the company, the 1,000 rupees which it has raised is a liability. This is primarily because if the company had not raised this 1,000 rupees, it would have no obligation tomorrow. And because it has raised 1,000 rupees today, it definitely has an obligation to repay this tomorrow. And the obligation is what we call as a liability here. So we can say as soon as the bank gave a loan of 1,000 rupees to the company, the bank has an asset of 1,000 and the company has a liability of 1,000. So the same loan having a value of 1,000 at T0 is an asset for the bank and is a liability for the company. So now we are looking at this example from the perspective of the company. So at T0, I'm going to say the company has a liability of 1,000. Now at T1, just at the time of repayment, let's say just before repayment at T1, the liability of the company is not 1,000, it is actually 1,120. Because what the company has to now pay, let's say this is just before the repayment, what the company has to pay the bank is not 1,000, it's 1,120. So we can see that at T1, there is the value of the liability is no longer 1,000, it is 1,120. So we can see in this example that there is a liability for the company at T0 and also at T1, but we can see that the value of the liability is not the same. Just like we saw that in the context of the bank had an asset at T0 and also an asset at T1, but the value of the asset was not same. Similarly here, from the context of the company, we understand that there's a liability at T0 and also a liability at T1, but the value of the liability is not same. And we further understand that just like how the asset value grew when we were looking at this from the perspective of the bank, from the perspective of the company, we can also observe the liability value is growing. So we saw that the asset value grew from 1,000 to 120. So similarly, we see here that the liability value is growing from 1,000 to 1,120 over a period of 1 year time. So what was 1,000 has now become 1,120. So we see a growth in the liability. And this growth in the liability is what I call as the cost associated with the liability. Now, let's say this was not there. Let's say the company raises 1,000 rupees and also has to give back only 1,000 rupees. Well, there is a liability at T0 of a value with a value 1,000, and there's also going to be a liability at T1 just before repayment, and that's also going to have a value of 1,000. So I raise finance, have a liability, and I settle my liability at 1,000. So I do not have any cost of settling my liability, right? So I raise 1,000, I give 1,000. Where is the cost there? But here, from the perspective, from the company's perspective, if you look at this, it raises 1,000, has a liability, but when it repays, it has repaid 1,120. So the growth in the liability says that the company is a cost in discharging its liability. And we understand that this cost, if expressed in as a percentage, is definitely going to be 12%. Because at the end of the day, the numbers are the same. We have 1,000 here, and we have 1,120 here. We're only calling it an asset when we're talking about the same about this example from the perspective of the bank, and we're calling it a liability when we talk about this example from the perspective of the company. But the numbers are the same. That means the growth rate is also going to be the same. So when you're looking at this growth as a growth in asset, we are talking about it from the perspective of the investor, and we call this as return on investment. And when we are talking about this growth from the perspective of a company, then we're looking at it as a growth in liability, and then we are saying that this percentage denotes a cost. And here, since this liability is in the nature of debt, we call this as cost of debt. So what we understand from this is the bank, which is the investor, has a return of 12%, and the company, which is the investee, which has raised debt finance, has a cost of finance raised of 12%. And what we understood at a concept level when we said return on debt finance is equivalent to the cost of debt finance is something that we can see here. We saw previously that RD was 12%, and now we see here that KD, which is cost of debt, is also 12%. Now, what we are going to do here is look at this example in a little more detail before we take our discussion a little further. Let's go back to our discussion here from the perspective of a bank. What has actually happened here when we calculated an R was we basically fit things inside a time value of money equation. So basically, let's say we are right now at T0. And if we are at T0 in the timeline, and T1 is going to denote end of first year, then we can definitely say 1,000 is the value as of today, and 1,120 is the value of something as of 1 year from now. So we can call this 1,000 as present value, and we can call 1,120 as the future value. So when we know the future value and we also know the present value, obviously we can understand that there's a difference only because of a growth, and that growth is what is represented as R. So basically what has happened is PV into 1 plus R to the power n is equivalent to future value is the basic time value of money equation that we have seen, where n represents the number of time periods, and here we are talking about time periods in terms of number of years. And in this example, to be specific, the number of time periods, the number of years is 1. So I can just instead of putting 1 here, I don't need to do that. So I say PB is 1,000, and I don't know the R. I want to work that out. I have my FV here, so I reverse work and I find out what my R is. So what has actually happened here in finding out my R is basically the use of the basic time value of money equation. We had an example and we understood the example, and once we put numbers in the timeline, basically we have reduced the example to a simple time value of money problem. And we worked out a time value of money problem, got a result, and again went back to our example and made sense of what we got. So the process is like this. We have an example. We understand what the example, we have some data. We understand what the data means, and then we take the essentials from it. Here the data is in the form of an example that we are looking into. We look at it, we understand what it is, then we pull the essentials from it, and then we put it in the form of a timeline, and we then formulate it into a time value of money problem, solve whatever we have to solve for, and once we get the result, we again take it back to the big picture which we are discussing about, and then try to make sense of what that number is that we actually spent time finding out. So here, when we found out 12%, basically it was just a time value of money problem, but when I take this 12% back to the main discussion that I'm having, then I understand that this 12% here is the return on debt investment, because I understand we are talking about things from the perspective of the debt investor. So what I want to first say here is that we are basically solving a time value of money problem here. That's very important to understand. And yet another important observation I'll have to make here is, now if I take this 1120 and I discount this 1120 by 12%, I'm going to get 1000. Let's try that out. 1120, and I discount it by 12%, 1.12 to the power 1, I get 1000 rupees. So if I know my future value, and if I know my discount rate, I'm obviously going to get my present value. So that's exactly what I've done here also. So I knew my future value, and let's say I know this 12%, but let's say I don't know this 1000 rupees. I can discount my 1120, add 12%, and I can get my 1000. So what this means is, if I know the future value and I know the return on debt investment, then I can arrive at the value of the debt investment today. If I know the future value of my debt investment and I know the return on my debt investment as a percentage, then I can obviously find out what is the value of debt investment today. And the future value of debt investment basically is a cash flow that I'm looking at. So let's look at this from the perspective of the bank. What is the bank expecting at T1? It is expecting to receive 1120. And what is the 1120 that the bank is going to receive? It's basically a cash inflow. So from the perspective of the investor, if you see, if I know what is the future value of my investment, and by that what do I mean? If I know what is the cash flow, future value of the cash flow from my investment, and I know what is the return on my investment here. Since we're talking about debt, we are talking about return on debt investment. So if I know the future value of cash flows from my investment, and I also know the return on investment rate, then I can find out what is the present value of my investment by discounting the cash flows using the return on investment rate. But here what has happened is, I knew the present value of my investment, I knew the future cash flows from my investment. What I didn't know was the return on my investment rate, the rate of return on my investment, and that's exactly what we found out to be 12%. So what's important to observe here is future cash flows associated with an investment, if discounted at the return on investment rate, if discounted by the return on investment rate, is going to give you the present value of the investment. And since an investment is an asset, now I can generalize and say, if there are future cash flows of an asset that you know, and if you know what is the return on investment in that asset, if you discount the future value of the cash flows associated with the asset at the return on investment rate, then you are going to be getting the present value of the asset. And this is a very fundamental valuation principle which says value of an asset today is the present value of all the future cash flows associated, discounted using the return on investment rate. So let me repeat that once again. Value of an asset today is the present value of all the cash flows associated, future cash flows associated, discounted to present value using the return on investment rate. So here, if I put that back, if I apply that principle here, what is the asset? It is a fixed deposit. What is the future cash flow from the asset? It is the 1120. At what rate should I discount to get the value today? I should discount it at the return on my investment rate. And what is the return on investment rate? It is 12%. So 1120 discounted at 12% for 1 year time, because that's the time of my investment, gives me 1000 rupees, which is the value of the asset today. So value of an asset today is the present value of all future cash flows, and the discount rate to be used is the return on investment. So there are three things: present value of the asset, cash flows from the asset, and the return on investment rate. If I know any of the two things here, I can obviously find out the third thing. And here, if you're going to be finding out the return on investment, we need to know the two other things, which is going to be the future value of cash flows associated with the asset, and we should also know what is the value of the asset today. Using these two things, we can find out the third thing, which is the unknown in this case here. Now, the same thing can also be said when we look at this from the perspective of the company which is taking the loan. Now, what happens here is 1000 becomes 1120, and if we find out what is the growth rate, it's 12%. Again, we are using a simple time value of money equation. We say 1000 into 1 plus r, the whole power 1, which 1 is the time period of the loan here, is 1120, and we get our r to be 12%. And this is the same time value of money equation that we saw earlier. Only thing here is we are talking about it from the perspective of the company, and we are saying that it's a liability. So here I can say that the value of a liability is the present value of the cash flows associated with the liability discounted at the cost of raising finance. So here's the difference. Earlier, the principle was about the value of an asset. Here the principle is about the value of a liability. Earlier, we were talking about cash flows associated with the asset. Now we are going to be talking about cash flows associated with the liability. Earlier, we were talking about discounting the cash flows at the return on investment rate. Now we are going to be talking about discounting the cash flows at the cost of finance rate. But ultimately, it's a time value of money problem. So what's the important takeaway here? The takeaway is the value of a liability, the present value of a liability is the future cash flows discounted to present value using the cost of finance rate. Since we are talking about debt finance here, we are saying we will be discounting the cash flows using the cost of debt finance rate, which is simply the cost of debt. So if we know any three things, right, if we know any two things, we can find out the third thing. If we know if we know the cash flows or future value of cash flows associated with the liability, and we know the cost of debt rate, we can find out the present value of the liability. Or if we know the cash flows associated with the liability and also the present value of the liability, then we can find out what is the cost of debt rate, which is what we have done here. So from the perspective of an asset and from the perspective of a liability, we can understand this as a principle. And this principle is going to be used by us heavily when we move on to further discussion. Great. So we've looked into one example quite exhaustively and understood how to find out the return on debt investment and how to find out the cost of debt finance raise from the perspective of the entity which has raised finance. And we've also seen how to look at this entire discussion from the perspective of valuation of an asset and valuation of a liability by framing the entire case into a time value of money problem. Great. Now let's look at another example here. Let's talk about a bank which has given a loan. The previous one is example 1. Let's call this as example 2. Example 2. Let's say we have a bank here and we have a company here, and let's say the bank has given a loan to the company, and let's say the loan is for 1,000 rupees, and now let's say the loan is for a 2 years time. Okay, so in the previous example we saw a loan for a 1 year time. Now let's see a loan for a 2 years time, and at the end of 2 years, let's say the company pays the bank rupees 1,210. Well, here we understand that just like in the previous example, the bank is the investor and the company is the investee which has raised finance. So the bank is going to have a return on debt investment and the company is going to have a cost of debt finance raised. We do understand all of those things. But let's again look at this example from the perspective of the bank which has raised finance and from the perspective of the company which has obtained finance. From the perspective of the bank which has invested finance, and from the perspective of the company which has raised finance. Let's first look at this from the perspective of the bank which has invested finance. Let's draw a simple timeline here. But this timeline is going to talk about 2 years. So we have T0 and we have T2 here. We have T0 and we have T2. Now, as soon as the bank gives a loan of 1,000 rupees, let me put this 1,000 rupees here, we can say that the bank has an asset of 1,000 rupees, like we said in the previous example. And as soon as the loan is received, as soon as the money is received by the bank from the company, at T2, let me put 1,210 here, which is the money that the bank receives from the company. We can say that the bank has an asset at T2 worth 1,210. So we have an asset at T0, we have an asset at T2, and the value of the asset at T0 is 1,000, the value of the asset at T2 is 1,210. So we can see the values are not same. We can see the value at T2 is higher, so we can conclude that the asset has grown in value. There is a growth, and we do understand that this growth is the return on investment, and here we can call this as return on debt investment. Let's understand what this return is. The moment we fit things in a timeline, we are basically looking at a time value of money problem. So let's formulate this into time value of money problem. 1,000 rupees today becomes 1,210 after 2 years. Let's assign a variable R, and let's say 1,000 grows at R percentage for 2 years and becomes 1,210. So 1,000 into 1 plus R, the whole power 2, because we said we had N as the exponent here, and N is for the number of time periods, and here we are talking about time periods in terms of number of years, so we can put 2 there. So 1,000 into 1 plus R, the whole power 2 is equivalent to 1,210. So what we understand from this is 1 plus R to the 2 is 1,210 divided by 1,000, that's 1.21. So if I take the square root of 1 plus R, I need to take the square root of 1.21, so I get 1.1. And now if I solve for R, I get R is equivalent to 10%. So what I understand from this example is the bank, which has invested 1,000 rupees by way of extending a loan to the company, has a return on investment, to be more specific, return on debt investment of 10%. But it's important to understand here that this 10% that we are talking about is per annum. This is 10% per annum. Now, how is that here? We do understand that in the timeline we have T0 and we have T2 here, but obviously we will have something called T1 here. And why we didn't write T1 in the timeline earlier was because we didn't have a cash flow at T1, right? We had a cash flow at T0 and we had a cash flow at T2, but we didn't have a cash flow at T1, so we didn't bother writing T1 in the timeline. But now to understand this 10% per annum, let's have T1 in our timeline. Let's understand what actually happens. Let me remove this here just to make some space available for our discussion. Fine. So let's understand what actually happens. Now we are saying that the asset grows from 1,000 to 1,210 at 10%, but here the asset grows by 10% every year for a period of 2 years. So what actually happens is, from T0 to T1, the asset grows by 10%, and from T1 to T2, the asset again grows by 10%. So now let's try that out. We saw that the growth rate in asset was 10%, which was the return that the bank got. So 1,000 grows at 10% for 1 year. So obviously we understand that then that would mean the value of the asset at T1 is 1,100. And 1,100 again grows by 10% and becomes 1,210. So 1,000 to 1,100 we see a 10% growth, and 1,100 to 1,210 we see another 10% growth. So we can see 10% in the first year, we can also see 10% in the second year, and that's exactly why I say this 10% is 10% per annum. Fine. This is something that is very important to understand. Now, although we say this is 10% per annum here, we understand that there is no cash flow at T1, and this needs to be understood a little more. And for that, I'll take a quick break from example 2 and let's go to example 1. Look at a certain point there and then come back to example 2 and understand this in a lot more detail. Let's get back to example 1 here. We had 1000 becoming 1120, right? And we looked at it from the perspective of the bank and from the perspective of the company. Now, what's important to understand is from the perspective of the bank, when it invested 1000 and got 1120, obviously the growth of 12% is because of extra money of 120. So this growth of 12% is because of extra money of 120. The bank gives 1000 but gets 1120. Now what is this extra money of 120? This 120 of extra money is what we call as interest. So we understand that in debt finance, the borrower of finance has to make a compensation payment to the lender of finance for using the lender's finance. So here in the example, if you see, the bank gives 1000 to the company and that's for 1 year time, and for that 1 year time the bank is not able to use 1000 whereas the company is able to. So the bank's finance is used by the company for 1 year and the bank is not able to use 1000 rupees. So the company compensates the bank for using the bank's money, and that's done by making a payment called as interest, and this 120 is what we call as interest here. And it's because of this interest that you have extra money coming to you here. It's because of this interest that the value of the asset has grown by 12%, and it's this interest here that has actually contributed to the return on debt investment. This interest here has contributed to return on debt investment. And similarly, from the company's perspective, it has raised 1000 rupees of money, but it is paying 1120. So it's actually paying an extra of 120, and this 120, the extra 120 that it is paying is what we call as interest, and that's a compensation to the bank which has lent finance, and this extra of 120 is what makes the liability grow, and that's what actually also contributes to 12% cost. Now, why is this important here? Now, when we come back to our example 2 and we understand that asset grows at 10%, now we are looking at example 2 from the perspective of bank. Let's finish this discussion and then look at it from the perspective of the company. Now when we look at 10% growth rate in first year and 10% growth rate in second year, now what do we understand by that? What we understand is there is going to be a 10% return in the first year and there is going to be a 10% return in the second year. And in the previous example, we saw that the return on investment is coming in the form of interest. So that would mean we have a 10% return in first year. So we will have some interest in the first year and we have 10% in the second year. So we would have some interest in the second year. Fine, but there's a problem here. We have T1 where there's no cash flow. So if there is an interest in the first year of 10%, then where is that money? It is not coming to the investor. Now, this is where we should understand or re-emphasize our understanding of the concept of compound interest. Now, when an investor earns interest, the interest that has been earned need not also be received. The interest can be reinvested for some more time. So what happens here is on 1000 rupees, the 10% interest, if you calculate, it comes to 100 rupees. However, at T1, there is no cash flow. The company does not pay the bank anything. But what happens is the company now is not getting to use 100 rupees, is also getting to use the extra 100 rupees. Had the bank invested the 1000 rupees, now it could have gotten 100 rupees, but the bank has now, let's say the bank had invested the money in some other place at 10% and taken it back after 1 year's time. Obviously it would have gotten 1100. So the bank is sacrificing its investment opportunity elsewhere and giving the money in the form of a loan to the company, and earns an interest of 10% for the first year, but the company does not pay the interest to the bank. The company now has the 100 rupees extra which it should have probably paid to the bank at T1 but does not pay, and uses it for one more year. So for the second year, the finance of the bank that the company is using is not 1000 rupees, it is 1100 rupees. So this is very important to understand. For the first year, the finance of the bank that the company is using is 1000 rupees. But for the second year, the finance of the bank that the company is using is not 1000, it is 1100. So for the second year, the interest that the company has to pay to the bank is still 10%, but not 10% on 1000, it is 10% on 1100. So 10% on 1100 works out to 110. So what actually happens is, for the first year, the company has to make a payment to the bank of 100, but does not make the payment at the end of first year. And for the second year, the company has to make a payment of 110. So together for the first and second year, the company has to make a payment of 100 plus 110, which is 210, and the entire interest of 210 is paid by the company to the bank at the end of the second year, at the time when the principal portion of 1000 is repaid. So we understand here that the extra money paid at T2 is 210, and this 210 is basically interest, and it has two things here. It has 100, which is the first year's interest, and it has 110, which is the second year's interest. So what we understand here is, for the bank which has given money in the form of a loan, at the end of T1, there is an interest which has accrued, which is actually getting reinvested for one more year. And for the company which has obtained finance, there is an interest payment due at T1, but however, it is not making the payment of interest to the bank, but rather using it. And for the second year, since it's using 1000 initial amount and also the interest of first year, it needs to pay 10% on 1100 and actually ends up paying 210. And when does this happen? It happens at T2. So we can say that now, let's look at the growth in assets. So 1000 becomes 1100. Why does it happen? It happens because the bank at T1, let's say at T1 for some reason, if the debt contract is broken and the company has to repay money to the bank, at T1, what amount should the company pay the bank? It must pay 1100. So what has happened is that interest that has accrued for the investor, which is the bank, has made the asset grow from 1000 to 1100. So at T1, if you look at the asset value for the bank, it is 1100. Now at T2, 1100 has grown to 1210 because of the second year's interest. So 1100 grows again at 10% to T2. So both of the years, the growth is 10%. Now, let's look at the same example from the perspective of the company. Only thing is the timeline is going to remain the same. Instead of calling 1000 rupees and 1210 as asset values, I'm going to be calling it as liability values. And instead of calling my 10% as return on debt investment, I'm going to be calling the 10% as cost of debt finance raised. And from the perspective of the company, I can say that at T0, the company has obtained 1000 rupees of the bank, uses it for 1 year, for which it has to make an interest payment of 10%, which works out to 100, but that does not happen. So for the second year, the company is using 1100 of the bank's money. So for the second year, 10% interest has to be paid on 1100. So for the second year, the interest is 110. So both of these things put together, the company makes a payment of 210 along with the principal of 1000, and that's how the loan is actually settled. So even from the company's perspective, the cost of debt is 10% and the cost of debt is of 10% is per annum. So we are having all this discussion here just to understand that this 10% is 10% per annum, and we're also taking this opportunity to try to visualize what this would actually mean and link this with the concept of compound interest. Now, in this case, at T1, let's say the company makes 100 rupees interest payment to the bank, and That if that is the case, then for the second year, 10% interest need not be paid on 1100. The 10% interest needs to be paid only on 1000. So in that case, at T1, there would be a cash flow of 100. The company would pay the bank 100 rupees of just interest, and at T2, the company will make a payment of 1000, which is towards the principal repayment, and then 100 rupees just for the second year's interest. So since that's not happening here, we understand that what's going on is compound interest here in this discussion. Now here also, once we have understood the return on debt investment and the cost of debt finance, once we understand how we'll have to formulate this into a time value of money problem, then do you want me to answer this from the perspective of the investor? Well, I would do that. I would call this as return on debt investment. Or do you want me to answer this from the perspective of the entity which has raised finance? Well, I can do that also, and I would call this as cost of debt finance raised. Right? That's fine. We have done that. Now here also, it's important to understand that if I take the 1210 here and I discount it to present value using at 10% over a period of 2 years, I would get 1000. So let me take 1210. So I discount this at 10% over 2 years. Now I'm obviously going to get 1000. So what does this tell us? We are able to re-emphasize the valuation principles that we saw in example 1. Value of an asset today is the present value of the cash flows associated discounted at the return on investment rate. And if I were to call this as a liability, then I would say the value of a liability today, and when do I call it a liability? When I'm talking about it from the perspective of the entity which has raised finance. So value of a liability is the present value of the cash flows associated with the liability discounted at the cost of finance rate. So that is a principle that's holding good even in the case of example 2. Now, in all these cases, what we have seen, in both of these cases, example 1 and in example 2, what we see is we have a certain time period, and in the time period, we don't have any intermediary cash flow. So although we discussed an intermediary point in time here, just to understand the percentage here, we actually didn't have a cash flow at T1 in example 2. So in example 1 or in example 2, we didn't have an intermediary cash flow. We had cash flow in the beginning, and we had a cash flow at the end of the time period. So in example 1, at T0 we had 1000, and at T1 we had 1120. And in example 2, at T0 we have 1000, and at T2 we had 1210. But we didn't have any intermediary cash flow, and that's something that we are going to look at in example 3. So in example 3, I'm going to be introducing an intermediary cash flow. In example 3 is also going to be talking about a 2-year window. It's also going to be talking about a bank loan, but we are going to be having an intermediary cash flow at T1. So let's look at example 3. Let's have our friends here. Let's have our bank, and let's also have our company here. And let's say the bank has given a loan to the company, and this is of a value of 1000. And let's say this is a 2-year loan, 2 years loan, and the company makes the following payments to the bank. Okay, at T1 it makes a payment of 100, and at T2 it makes a payment of 1100. Now what we are supposed to find out is what is the cost of debt finance and what is the return on debt investment. Great. We definitely understand here that there is a cash flow at T1. So in our timeline, we are going to definitely be having an intermediary cash flow. So when there is an intermediary cash flow, let's understand how the cost of debt finance and how the return on debt investment has to be found out. Again, let's first approach this example from the perspective of the bank, which is the investor, which has invested money in giving a loan to the company. And let's then look at the same example from the perspective of the company, which is the investee, which has raised finance in the form of debt from the bank. Okay. from the perspective of the investor first. Let's draw the timeline. We have T0 and we have T2. But now it's important that in the initial discussion itself, we have T1 in the timeline because we know there is going to be a cash flow at T1. Let's put all the cash flows here in the timeline. At T0, we have 1000. And at T1, we are going to have rupees 100. And at T2, we are going to be having rupees 1100. Great. What is the return on debt investment for the bank? Now, we are going to mainly approach this example 3. We are going to approach this example 3 by applying the valuation principle that we have seen. What does that mean? That means when we are talking about this from the perspective of the bank here, this 1000 is going to be an asset, right? So at T0, as soon as the loan is given, this is going to be an asset, and this 1000, I would call this as the present value of the asset. So value of the asset today at T0, present value of the asset is 1000. So if I apply the principle that we have been talking about, then I would say the value of an asset is the present value of the cash flows associated with the asset discounted using the return on investment rate. So that would mean I'll have to take all the cash flows associated with this asset, future cash flows, and I have to discount it using the RD rate, the return on debt investment rate. What are the future cash flows associated with this investment? There is 100 rupees that I'm going to receive at T1. Now, why do I say that? I said the company makes a payment of 100 to the bank at T1. That would mean the bank would receive 100 from the company at T1. And then the company would make a payment of 1100 at T2. That would mean the bank would receive 1100 at T2. So at T2, there is 1100. So that I would say at 2 points in time in the future, there are cash flows associated with the asset. So if I bring this 100 and also this 1100 to present value, then I can get my if I bring these cash flows to present value using the RD, then I'm supposed to be getting my 1000, right? So now this is a principle that we have seen. Let's first fit this into a time value of money equation and let's take things further. So 100, I don't know what this R is now for the time being. So let me assign a variable R to it. So 100 divided by 1 plus R the whole power 1, because I need to discount this by 1 year. From T1 I need to get this to T0, and I'll also need to get the 1100 at T2 to T0. That means I'll have to discount this 1100 by 2 years at the return on investment rate, which is what I've assumed to be R right now till I find that out. 1 plus R to the power 2, and obviously I'm going to add it. Now this entire thing must be equivalent to 1000. So this is the equation, valuation equation you see. Now it makes sense. Value of the asset today is the present value. So I'm bringing the something to present value, and what am I bringing? I'm bringing 100 and 1100, which are the cash flows. So the R that satisfies this equation is the return on debt investment. The R that satisfies this equation is the return on debt investment. Now, how do we go about solving this equation, right? Well, we are not going to be looking at how an equation like this has to be solved. We will reserve this for a discussion later. But let's adopt a shortcut right now. Get this R, try to fit that in this equation, and try to see if it actually works. We will look at how to solve this later, but let's try to look at a shortcut, get this R first, and then confirm our understanding by using R, whatever we got for R here in this equation, and see if this actually works, okay? Fine. Let's take a simple way out. Now I can say that let me break this entire thing into principal and interest cash flows. Great. So 1000 rupees, which is the initial value, that initial amount that moves from the bank to the company, is what I call as the principal. And at T2, there is obviously an amount that is moving from the company to the bank. and that amount that moves from the company to the bank at T2 is 1100, and 1100 is basically 1000 plus an extra 100. So I would say that what actually happens is that extra 100 at T2 is an interest amount. The 1000 which the company gets from the bank is repaid, and the extra is interest. We saw that in example 1 and 2, right? Over and above the principal, if you are making any payment on an amount that you have obtained, that's an interest payment. And for the investor, over and above the amount you invested, if you're getting something, that's going to be an interest amount. Great. So that would mean 1000 is the principal value, and the interest values are 100 at T1 and 100 at T2. Now, once we capture this, let's forget the interest for a time being. Let's just look at the principal value. Now, what we see is, for the time being, let's forget interest. Let's just look at principal, and let me draw a quick timeline here. Just focusing on principal. This is not the main timeline. This is the main timeline that we're discussing. This is just for an intermediary understanding. Let me have 1000 here as the principal, and let me again have 1000 here as the principal. This is T0, and let's say this is T2. If I just look at the principal cash flows from the perspective of the bank, okay, now we're looking at this from the perspective of the bank. As soon as I gave a loan at T0, I have an asset worth 1000, and at the time I got back my principal, if I look just at principal, I have money at 1000, so I have an asset of 1000 here. Again, it's important to note this is not the complete timeline. This is just a part of it, just for an intermediate understanding. So at the time I gave a loan, I have an asset of 1000, and at the time I got back my loan, I again have an asset of 1000. So we can see that if you look at just the principal values of the loan, the principal of the loan given and the repayment of the principal, you can see that the asset value did not grow. It grew, I would say, by 0%. Fine. So if I just look at the principal values, there is no growth at all. But what actually happens is, in the 2 years' time, there is 100 that comes from the company to the bank at T1, and there is another 100 that the bank receives from the company at T2. And these are interest payments. So although I say that the principal does not grow in value, it does not mean that the bank is not getting a return on investment. It's getting the return in the form of interest payments. And in fact, if you look at example 1, we said that growth of that 1000 to 1120 was only because of the extra 120, which was interest. So here, though the principal is not growing, which you cannot expect to grow in cases like these, you understand that you will definitely get a return in the form of an interest payment. And what is that interest? It is 100. So on 1000 rupees, 100 of interest is going to be 10%. So in the first year, obviously there is a 10% return, and in the second year, 1000, on 1000 you get an interest of 100, so it's going to be 10% in the second year also. So each year if we have 10%, then we can say that the return on debt investment is 10%. So I would now conclude here that the return on debt investment is going to be 10%. Now let me try to put that 10% here back into the equation, the time value of money equation that we have framed, and let's try to discount here. Let me take the 100 here, discount the 100 to present value using 10%, 1.1 to the power 1, and let me take the 1100 here, which is 1000 plus 100, and discount this by 10% for 2 years. So when I discount 100 at 10% for 1 year, I get 90.91. I'm just rounding off to 2 decimals here, and when I discount 1100 by 10% for 2 years, I get 909.09. Now if I add both of these two things here, I am obviously going to get 1000. So what we understand here is the return on debt investment of 10%, if it is used for discounting the cash flows associated with the investment, you're still getting the present value of the investment. So here 10% if it's used to discount the cash flows, we exactly get 1,000 rupees, which is what we were supposed to get. And we in fact said before we started this discussing this, all of this, and before we arrived at the 10%, we said that the R that solves this equation is a return on debt investment. And here, 10% solves this equation. That would mean 10% is the return on debt investment. So even when we have intermediary cash flows, the principle here that the value of an asset is the present value of future cash flows discounted the return on investment definitely holds true. So whether we have intermediary cash flows or we don't have intermediary cash flows, this principle is going to hold true. And from the perspective of the company, it's going to be very simple. I'm going to call this 1,000 as a liability, and I would say that this at T1 the company has to make a payment of 100, and at T2 the company has to make a payment of 1,001. So the same timeline, at T0 it will receive 1,000, at T1 it will make a payment of 100, and at T2 the company has to make a payment of 1,100. And we have seen that the present value of a liability is the future cash flows associated with the liability discounted at the cost of finance rate. So now here we can still use the same equation. Only thing is that we are looking at it from the perspective of the company. So 100 is a future cash flow associated with the liability, and 1,100 is also a future cash flow associated with the liability. So if I discount both of these cash flows to present value, obviously using 10%, I'm going to get 1,000. So that would mean 10%, which is return on debt investment, is also the cost of debt. So my return on debt investment is 10%, and I know that this is also the cost of debt finance. So we have looked at this example from the perspective of the investor, which is the bank, debt investor here, and also from the perspective of the debt investee, which is the company which has raised finance in the form of debt. Now this understanding that we have had is going to be very useful, and we will be applying this later when we look at the concept of cost of debt in the context of bonds. But one thing that I'd like to highlight once again is when we have formulated things to a time value of money equation like this, we always need not, and in fact should not, go back here and try to find out a rate like this, what we've done here, come back to our equation, substitute, and then find out if our answer is correct. There's going to be a methodology for calculating this R here if we had an equation like this, even without having to do this. So here I've done this just, I would probably call this as a crude way of working, just to understand and re-emphasize the point that this entire valuation principle holds good even when we have intermediary cash flow. So it's only for that purpose that I've done this and then used that percentage here. But we are going to be having a method to calculate this R without having to go here. In fact, we're going to be having two methods to do that. But we will not be looking at those two methods now. We will be looking at those two methods only when we look at cost of debt in the context of bonds. So we have now seen three examples, and I think at this stage we should be having a fair understanding of the return on debt investment and the cost of debt finance. So if I put all the three examples together, and I'll have to make some observations, probably they would be these. One, for the investor, the investment is an asset, and that would have some future cash flows associated, and there is going to be a return on debt investment. And if the return on debt investment is used to discount the future cash flows, then you would get the present value of the asset. And if we have the present value of the asset and the future cash flows, we can obviously find out the return on debt investment. And from the perspective of the company which has raised finance, so from the perspective of any entity for that matter which has raised finance, there's going to be a liability, and there are going to be cash flows associated with the liability, and there's going to be something that we call as the cost of finance. Here we are talking about debt finance. And if we discount the future cash flows associated with the liability using the cost of finance rate, we will get the present value of the liability. And if you're given the present value of the liability and also the cash flows associated with the liability, we can obviously find out what is the cost of finance rate. And this is going to hold true whether or not we have any intermediary cash flow. So example 1 and 2, we didn't have any intermediary cash flow, and example 3, we obviously had an intermediary cash flow. Now, One important point after having understood all of this about cost of debt, a very important point that we should now look into is the concept of tax in relation to cost of debt. Now, whenever we talk about debt financing, there are a lot of tax implications. There are going to be tax implications for the investor, and there are also going to be tax implications for the investee, which is the entity which has raised finance. So, for the entity giving finance and for the entity raising the finance, there are going to be tax implications. However, in example 1, 2, and 3, we have not looked into tax implications, and that's mainly because I wanted to first introduce the concept of cost of debt without having to worry about extra things. Now that we have an understanding of what is cost of debt, we'll have to definitely incorporate the tax implications involved. Now, before we do that, let's first try to understand what are the tax implications associated with debt finance, and why do I say that there are tax implications for the investor and also for the entity which has raised finance. Now, in most countries, the cash flows associated with debt are taxable in the hands of the investor. Now, when I say cash flows here, I am talking not about the principal cash flows associated with the principal, I am talking about the cash flows associated with the interest. So basically, to put it in simpler words, I can say the interest on debt finance is taxable in the hands of the investor in most countries. So basically, if you look at it, the interest received by the investor on the investment made is an income for the investor. And obviously, tax is something that's levied on income. So when the investor receives interest from the entity which has raised finance from the investor, that income is taxable in the hands of the investor. And this is the case in most countries. So we are going to be having a tax payment that the investor needs to do on the interest cash flows, and that is going to have an impact on the return on debt investment. And we are also going to be having a tax implication for the company. Now, what's the tax implication for the company? Well, we understand that one person's expense is another person's income. We have now understood that one person's cost is another person's return. Now, this kind of understanding is also going to help when we look at tax. If a certain item is taxable for one person, in many cases, it will be tax deductible for another person. So here, the interest, which is an income for the investor, is taxable in the hands of the investor. And that would mean that the interest, which is an expense for the company, is going to be tax deductible for the company. And what does this mean? What do I mean when I say interest is tax deductible? Well, when any entity calculates the tax amount that needs to be paid, it is basically an amount calculated on what we call as a taxable profits. So the entity arrives at taxable profits or taxable income, and in most cases applies a certain percentage on that, which is called the tax rate, and we say this is the tax amount that needs to be paid. In arriving at the taxable profits, what happens? Several items of income are taken, and several items of expenses are deducted from those items of income, and then we have the net income, which is taxable, and that's what we call as taxable income. So what's important to note is, after taking the several items of income, we are subtracting several items of expenses from those items of income. Now, one of the items of expenses that can be subtracted in calculation of taxable profits is this item called as interest on debt finance raised. And that would mean the taxable profits for the entity which raises finance is going to reduce. And if that reduces, it would mean that the tax payment that the entity needs to do would also reduce. And that's if tax payment that the entity needs to make reduces because of interest, which is related to debt finance, we are going to see that that has an implication on the cost of debt finance raised. So at this stage, it's important to understand that the tax implications are very important when we talk about debt finance. So we are going to have tax affecting the return on debt investment, and we're also going to have tax affecting the cost of debt, and we'll definitely need to take a look into how tax affects the return on debt and the cost of debt.